How I turned a 10-unit building into financial freedom. 70% of Americans live paycheck to paycheck, but here's a secret. The average 12-unit apartment building in the Midwest, a college town, it can throw off $3,200 a month after the mortgage, every single month. That's predictable, powerful income. I bought my first 10-unit building with just $11,000 in my bank account in zero family money. I used my knowledge and partnered with someone who had some capital. And today, I'm gonna pull back the curtain and show you the 5-step engine that turned that one deal, that building, into a cash machine that funds my entire life. Do me a favor, comment below whether capital or finding deals is your biggest hurdle for why you haven't started yet. And like this video so that way it lets the algorithm share it with other people just like you. Let's go. I'm not here to sell you any courses or anything. I'm here to hand you the owner's manual. On the surface, an apartment building, it just looks like walls, doors, tenants, maybe problems, whatever it may be in your mind. It hides 3 powerful wealth levers: steady cash flow, long-term appreciation, and consistent loan paydown and tax avoidance. Pull those levers in the right order and your building becomes an ATM machine that refills itself. Miss one and you're stuck in a money pit. 2 a.m. calls dealing with toilets and tenants. By the end of this video, you'll know exactly how to flip that switch and build a real working machine. Step 1, find the right deal. Forget the big deals, skyscrapers. Start with 10 to 30 unit apartment buildings. It's more mom and pop. In a market where it makes sense, where jobs are growing, where the economy's humming, and look into 3 quick indicators. Median household income at $65,000 or greater. Population growth at 1% growth or greater. Job growth at 1% or greater. You can use AI to get this information. We even have our own AIs. All of that stuff, it's very easy to get now. Another thing is you want vacancy rates, generally speaking, in the market below 7%, and crime trending down for the last 3 years. These numbers tell you one thing: stability. And then do what I call the 10 p.m. test. Drive the neighborhood in the evening at night. If you see porch lights, kids on bikes, not too many bars on the windows, that's a green light. Next, filter listings for properties built between 1970 and 2000. Cheap enough to buy, modern enough to avoid major system overhauls. And finally, run the 1% rule. Doesn't always apply, but this is where the monthly rent should equal at least 1% of the purchase price. $400,000 building, $4,000 a month in rents for the building. You're not just buying brick and mortar, you're buying an income stream wrapped in a brick. Step 2, fuel it with smart money. Banks want typically 30 to 35% down, not 20 or 25, okay? This is commercial deals we're talking about. But that money doesn't have to all be yours. My first 27 unit, I found a local portfolio lender who only needed 25%. We were lucky. As long as the debt coverage ratio, right, the DSCR, was at 1.25 or greater. That told them the income easily covered the mortgage. Keep in mind, they're giving the property the mortgage, not you. You want to get creative? Negotiate seller financing. Offer them 8% interest, 10-year balloon, 15% down. Retiring landlords love this to avoid taxes, and they don't have to deal with it. Try house hacking, a fourplex. I've seen that happen even on FHA with 3.5% down if that is the worst case scenario to get into your first one. Your credit does need to be reasonable, 600 or greater. So if it's below that, it's just not the right time yet. You need to get your credit fixed. Bottom line, the down payment is a math problem, not a moral test. Stack sources, right? Your money with other people's money, and that's how you scale. And so this is where the fun comes in. The rent comes in, expenses go out. Your goal is to keep that spread as fat and predictable as possible. I typically budget 40 to 50% of the gross rents towards operating expenses. 10% for maintenance, 8% for vacancy, 8% for management, 5% for capital reserves, 7% for some of the property taxes, 10% for insurance. Generally speaking, where that rolls. And what's left after the mortgage is your cash on cash return. Shoot for 6 to 10% as a minimum for these markets. And if you want to boost the cash flow, look for small, high-impact moves. Raise the rent, $50 a month per unit. Do some light upgrades, paint, flooring, fixtures. You can also add in things like coin laundry, reserved parking, stuff like this. Even if it's adding a little bit per month, it adds a lot to the net operating income at the bottom. You can use what's called RUBS, reimbursables for utilities, that you get reimbursables back from the tenants to cover a portion of the utilities. Every tweak adds torque to your flywheel. After 18 months, my first 10 unit was spinning off $2,800 more than my old salary was. Once that flywheel covers your lifestyle, you've bought freedom in the brick form. Step 4 is the appreciation accelerator. Next, we're going to hit the turbo button. You can't control the market appreciation, but you can force it on your own. Let me give you an example. Bought a 14 unit that was 78% occupied. 1990s carpet, brass fans, the works. Spent about $4,500 per unit. Simple upgrade. Put in LVT flooring, subway tile, nickel fixtures. Within 90 days, rents jumped $200 per unit per month. That's $33,000 more in net operating income. At a 6.5 cap rate, I created over $500,000 in new equity right in my pocket. That's not investing, that's legal alchemy. Here's a bonus tip for you. Appeal your tax assessments. After the renovations, I shaved off almost $38,000 off my appraised value and saved $800 a year in property taxes. Forced depreciation is how you turn vinyl plank into wealth. Step 5 is where the machine really scales. The refinance and repeat. After 24 months of stable performance, that same 14-unit building appraised for $1.35 million, up from $650K. I refinanced at 75% loan to value, $262,000 tax-free money. That cash became the down payment for another 36-unit I bought. The tenants pay down the new loan, the cash flow barely dipped, and my door count doubled. That's how you turn equity velocity into door velocity. Just remember, only refi if you're post cash out. Your debt coverage ratio still clears the 1.25 DCR. Otherwise, it's going to be very difficult and you probably won't get the loan proceed. Here's the biggest mistake to avoid, the fastest way to kill your wealth machine: underestimating the R&M, the repairs and maintenance costs. I once budgeted about $1,200 per unit, but the real cost was $2,850 thanks to hidden costs. You got to do proper inspections before you buy these things. Lesson learned. I always get third-party inspections and I add 30% in contingency. If the deal still cash flows, that's the worst case scenario. I preserve and protect. Multifamily is incredible if you utilize it correctly. If you want to learn more on how to do this, click the link here and watch my video about how you can own a 10 to 30 unit apartment building in the next 90 days with as little as $30,000 out of pocket. I break it all down. Your first apartment building isn't a fantasy, it's a 5-step system. First, the right box. Find the right deal. Fuel it smartly. Spin the right flywheel. Force the appreciation, hit the turbo button. That's exactly how I went from broke, $11,000 in my bank account, to 1,200 doors and over $200 million in assets. The only difference between you and me is that I started. I jumped off the cliff. So today, analyze one deal, call one broker, take one step, write an LOI. Because the best time to plant your money in that tree is 20 years ago. The second best time is right now. Go build your wealth machine, and I'll see you in the next deal. Until next time, take care and happy investing.